today's session, we're going to take a look at shareholder value, and in particular, economic value added, and its relationship to the weighted average cost of capital that we talked about in our earlier session. Essentially, one of the most fundamental issues that we have in performance management is to determine when we are creating shareholder value. When do the actions of management contribute to shareholder value? And also, as importantly, at what point do management actions destroy shareholder value? The simplest metric that we have is to take a look at the rate of return and to ensure that we get some kind of return in excess of our cost of capital. So the simplest way to describe this is to say, at what point is the return on invested capital greater than the weighted average cost of capital? The term economic value added itself is relatively new, but we've been using terms that relate to shareholder value for a very long time. If you go back to the middle of the 19th century, economists, going right back to Karl Marx, talked about the idea of surplus profit. In other words, a profit in excess of a fair return to capital. And Alfred Marshall, in the first textbooks at the end of the 19th century, also came back to that same term, describing it again as surplus profit. By the time we get into the middle of the 20th century, the focus on shareholder value management becomes greater, and if you don't do a good job in producing shareholder value, you can expect a number of things will happen to the company. Management bonuses will disappear. The management themselves might be changed by a board of directors. If the board of directors doesn't act, activist shareholders may lead revolts and perhaps either change the management and the board of directors of the company, or lead to the company being taken over. So shareholder value is top of mind for senior management. Essentially, we see it as an alternative to raw profits. Net income is an important thing to know, and that retained profit is the lifeblood of the company. But we know that we have to make not just a return on our investment, but we have to make a return on our investment that accounts for the cost of the capital that's employed. So if we have $1 billion of capital employed, there is rent required on that $1 billion worth of capital. And that rent has to be greater than the actual return that we made. It can be measured and used at several different levels in the organization. We can look at it on the corporate overall level. We can look at it on a business unit, divisional level. There's even evidence that it's been used in organizations to determine individual bonuses. One of my ex-students called me and told me that her company was now instituting EVA as a tool to determine her division's performance and her bonus. She was responsible for a pharmacy organization's operations in Africa. And while she worked from Geneva at their head office, her operations in Africa were going to be measured. And if they didn't produce economic profit, if they didn't produce that EVA, then her bonus would be small. That was a problem because she needed continual reinvestment. She needed new capital. And essentially the business couldn't grow if she followed those EVA rules, at least not in the short term. Together we worked on a proposal for her boss to essentially modify the rules, which would allow her business to catch up with a lot of the other parts of the organization's worldwide operations. Markets also tend to reward companies that announce that they use some kind of shareholder value management tool. If they use EVA, essentially they're saying, we put the interest of our shareholders first. Not every company has done that. In fact, Google, when they floated their business, made a statement as part of their initial public offering documentation that said, we have several priorities. EVA is only one of them. And it was important that they put that up front, because essentially that told the market that you're not our only interest. Before we go any further, we should probably explain what we mean by value added. If you think about sales as the total activity of the organization, who benefits from those sales? You can take part of the selling price and attribute that to inputs that are purchased from outside. Clearly, that is not part of the value-added process in the company because we're buying components from other suppliers. We're buying the raw materials. We're buying components that are partly completed. And so we subtract that from our sales to get a very rough measure of value added. Within our value added, we have the value added that's attributable to the labor that's been provided by our own workers. So those labor costs are then, and other fixed costs, the cost of electricity and heat and telephone and things like that, are also taken out, because those are the fixed costs, the charges against our value added that are not really going to be part of our ultimate profit. So if we subtract those fixed costs, the labor cost especially, that leaves us with a measure of added value. And in accounting terms, that's described as our operating profit, or our EBIT. Within the operating profit, though, our total added value can be further broken down. We have the true EVA, and we've also got a return to capital. And we call that the capital charge, or the rent that we have to pay on the capital that we use. And essentially that capital charge is calculated by taking the total amount of capital employed in the business and multiplying it by a discount rate, our weighted average cost of capital. The term EVA became very popular during the 1990s, especially when we saw that some companies excelled. And at the top of the list of excellent companies in terms of producing shareholder value, we had Coca-Cola. Coca-Cola, year after year after year, had a rate of return that was high enough to pay a fair rate of return to the investors and leave something else to reinvest in the business. The CEO of the company became famous as being the best at creating shareholder value. His name, Roberto Goizueta. He was a very hardworking, chain-smoking, very smart guy who ran his business very well. And when he was asked, he was uncharacteristically modest for such a top performer. He said, well, what I do is very simple. He said, I got paid a lot, to make the owners of Coca-Cola increasingly wealthy with each passing day. Essentially, he said, we produce syrup, we sell it to our bottlers. I make sure that the price that I get for that syrup is going to be high enough to be able to pay a fair rate of return to the investors and leave something else to continue to build the company. So not only was this good enough to get him at the top of this list, they even named a business school after him. The calculation of EVA, as it's been characterized by several consultancy businesses, and among those we have one called Stern Stewart, which has made a business out of calculating EVA using a particular bespoke method. Essentially, they say they start off with operating profits less the taxes, so our net operating profit after tax, or NOPAT. And then they have to calculate the cost of capital. They do that very carefully. They do that using a special formula, but essentially it's the weighted average cost of capital that we've already seen. They use weighted average cost of capital. They use CAPM to calculate the cost of equity. Then the hard part is to determine exactly how much capital has been used in the business. And to do this, they've made several adjustments. They say we're going to take the research and development that we've expensed and we're going to add that back. It's going to give us more capital, it's going to increase the capital charge, and it'll give us an honest measure of our total capital employed. They'll also add back some of the training costs. They'll add back brands that have been written off and any goodwill from acquisitions that has also been written off. And this increases the total amount of capital employed in the business, increases the capital charge, and uses a more conservative measure of the EVA. Now, we can't do this unless we have all of the inside information, but this is part of their consulting business, and this is something that companies would ask them to do. Generally speaking, our calculation of EVA goes through several different steps. The big picture is that we're going to take the total amount of invested capital, we'll come back to what that means in just a minute, and we'll multiply that by what they call the EVA spread. Now, EVA spread is the return on invested capital minus the weighted average cost of capital, R. And remember, the R is going to involve the weight of debt. We've seen that before. the weight of equity, the cost of debt after accounting for tax, and the cost of equity. Oh, and by the way, I see we've got a slight error here. That should be E over D plus E. Return on invested capital is just what it sounds like. Return on invested capital. In this case, the NOPAT is another term that we just discussed. It's essentially the operating profit after accounting for tax. So, for example, if we have $100 million in EBIT and we have a 20% tax rate, our NOPAT would equal $80 million. The invested capital is simply the market value of debt over the market plus the market value of equity. Now, we can calculate that in more complicated ways, and we'll take a look at that in just a second. But I like to use the market values, and the reason for that is that market values are constantly updated with new information from the markets. They consider the present value of the future cash flows in order to calculate the cost of equity. The market value of debt is typically the same as the book value of debt, but if we did have market prices for bonds, we should also include that information. Generally speaking, we'll use the book value of the debt plus the market value of the equity. That's something that we discussed under the weighted average cost of capital. Now, these are some of the things that we need to know. We need to know the return on invested capital, we need to know the weighted average cost of capital, and we need to know how much capital was employed in the business. We'll come back to another example of this and some alternative ways of calculating that in a couple of minutes. We like to use the invested capital, the market value of equity especially, but we can't always get that information. Sometimes we have to use the book value, and that's because companies that aren't publicly traded don't have a share price that's publicly updated, and so we can't get that market value. We can also calculate the invested capital by using an accounting approach. This is part of a table that is from our textbook, and essentially it says that we first off have to calculate the net operating working capital as part of our total capital involved in the business. And to get that, we take the operating current assets, subtract the current liabilities. That gives us our working capital. We can make some fine adjustments to that by deciding what's operating and what's not, but essentially the things that are necessary to keep the business going. Inventories and accounts receivables are part of our current assets. Cash, not so much, especially if it's in large amounts. Current liabilities include the most of the current liabilities that are part of our recurring operations. So that gives us our working capital calculation. We add our working capital to our long-term assets, basically the fixed assets of the business and investments in other company, and that gives us the total capital employed in the business. And so that would be a measure, an alternative measure to use for the capital employed in the company. A couple things to remember. We normally use the market value of equity and debt to calculate invested capital. The market value of equity is the share price times the number of shares that are outstanding. The market value of debt, it's difficult to find, so we use the book value, or we tend to use the book value. For the tax rate, it's better to use the marginal tax rate. That's the tax rate going forward. So if the system has changed and taxes have been cut, as they have in the United States, for example, in the last year, then we would use the tax rate on the next dollar that the company is going to make at the published rate, not the historical tax rates, because those numbers can be misleading. Our net operating profit is essentially operating profit times 1 minus the marginal tax rate then. T sub C is our marginal tax rate. That's an awful lot of foundations. Let's take a look at an example. In this example, we have a company that operated operated from about 1920 right through until 2000, with mixed success. Some years they were stronger, some years they were worse off. Their name was TI Group, and TI stood for Tube Investments. Originally founded in 1919, it was part of the industrial history of the central part of Britain. They had over decades made many acquisitions that built the company into a colossus. They were one of the top 30 firms in the UK by the beginning of the 1990s. Their brands included things like Raleigh bicycles, BSA cycles, several appliance manufacturers, but essentially what they did was they made tubes. They made tubing that was used in the aerospace industry, in refrigeration, in the automotive business. That's why they were called Tube Investments, and later on just known as TI Group. But their business had become very much of a conglomerate. They were involved in everything that involved tubes and many things that didn't. They got into retail, they got into finance, they became a mess. Really, by the time they got to the middle of the 1980s, everybody recognized that this kind of a conglomerate was never going to perform. The board of directors quietly got rid of their previous CEO, who is essentially considered to be the CEO for life, and replaced them with an engineer by the name of Christopher Lewinton. I had a chance to introduce Christopher and basically make this presentation in the mid-1990s at a meeting of the Institute of Mechanical Engineers, and he told us the story of the simple things that he did to make the business successful. The company was recognized as owning some of the most famous brands in the world. Raleigh Bicycles at one time was the biggest bicycle manufacturer in the world. They had a massive operation near Nottingham. It was world famous. And he recognized that while this was a famous brand and a wonderful brand, it wasn't making any money for the shareholders. In fact, he said about 75% of the businesses that they were in were not creating any kind of shareholder value. This was a term we hadn't heard so much, but his laser focus was on the shareholder value. He said, if we have a business that doesn't make money, why do we have it? He shrunk the company considerably from the first day that he got into the business. He sold off many of the business units. He did buy a couple, but those business units that he bought were ones that were going to add shareholder value. They tended to fall within three very narrow definitions. Tubing that was used in refrigeration, tubing that was used in aerospace, and tubing that was used in the automotive business. So his acquisitions had to fall into those categories. He got rid of businesses like Raleigh Bicycles and BSA. In some cases, all he did was he shut the business down. In other cases, he sold the business, perhaps to a competitor, and in a couple of instances to the managers that were operating the plants. So by the end of his first couple of years in his job, by the beginning of the 1990s, the business had shrunk, and it started to grow again through acquisitions, but focused acquisitions, and always ones that created shareholder value. You could see a little bit of evidence of this in the calculation. To start with, he had to calculate the cost of capital. If we looked at the company and its published information, we'd see that the average interest that they paid. And remember I said we should try to use the marginal interest rates and the marginal tax rates. Well, here we've started off with the average interest rate. We've got the share price information as well. The average share price over the year was 342 pence. The number of shares outstanding was 116, so 342 times 116 million shares outstanding gives us market value of the equity of 398 million pounds. We can calculate the weighted average cost of capital. We've already done CAPM, and you can see according to this, the cost of equity using CAPM was 16 0.8%. Now, we didn't actually calculate that here, but that was the number that we brought in from outside. We also said the cost of debt was 8.3%. Total capital employed in the business, we have $448 million pounds in debt and 398 million pounds in equity. So 448 plus 398, about 845 million pounds total equity. 448 divided by the total capital means we've got 52% debt. 398 divided by that total capital gives us 47% equity. 100% is the total, so that's the right number. 8.3% times 52%, our after-tax weighted average cost of debt is 4.39. 16.8 times 47% gives us 7.9. So the total cost of capital, average cost of debt, the average cost of equity weighted, 12.3%. Now, with that information, we can calculate the EVA. We start off by taking the operating profit from their 1995 financial statements. 138.6 million pounds of operating profit. Our subtraction of tax at their marginal tax rate, we subtract 39.5. That means they're NOPAT, and that's our NOPAT, 99.1. Now, we have a weighted average cost of capital we've just calculated of 12.3%. Capital employed in the business, 698 million. So 12.3 times 698 gives us a capital charge of 85.9. 99.1 is the NOPAT. Subtract from that the capital charge. That means our EVA is 13.2. Is that a good number? Well, any number greater than 0 suggests that they've created shareholder value in excess of a fair return. So fair return on capital was 85 million. They produced 99. Their return to the business, the return to the shareholders, a positive number, and therefore Christopher, and shortly afterwards he became Sir Christopher, had done a good job in creating value for the shareholders. The company was very successful in its restructuring, and it ran very well until about the year 2000, when through a number of other mergers it became part of a bigger enterprise. And so this is essentially a success story of turnaround in a very, very old, and some people would say defunct, part of the British industrial economy. Our calculation of EVA then, as we've already seen, and in a way this is partly a summary, first we have to calculate the correct weighted average cost of capital, our discount rate R. Then we're going to calculate our net operating profit after tax, and remember that's the operating profit, EBIT, times 1 minus the marginal tax rate. Next we have to calculate the return on invested capital. We need our NOPAT for that, and NOPAT is divided by the invested capital. We'll come back to invested capital again in a second, but that's the cost of the equity and the cost of the debt. To calculate the EVA using a capital charge, we need to know what the capital charge would be. So that would be our invested capital, the market value of equity, and probably the book value of debt, times the weighted average cost of capital. And then our first version of EVA would be our NOPAT minus the capital charge, which is the approach that we've just used. An alternative is the one that I discussed at the very beginning of this session, and that would be to take the invested capital and multiply that by the EVA spread. And that's the term that we use to describe ROIC minus R, the EVA spread. Now remember, we expect ROIC to be greater than the weighted average cost of capital, and so if this is a positive number, then that's going to be the rate at which we're creating profit for the company. So it's an important term. So first calculate the weighted average cost of capital, then the NOPAT, then the rate of return on invested capital, then the capital charge to calculate the EVA. An example of the application, and more importantly even, the interpretation, comes from information that we get, in this case, secondhand from our Bloomberg terminal. Here we've got a company that most people in Canada know very well. It's called Blackberry, or used to be called Research in Motion. At this point in its history, it's not a great example of shareholder value creation. You can see that on this page, on our terminal, we have some basic fundamental information. The company's market capitalization, total capital, is basically all equity. Nobody wants to invest debt in this type of business, so it's funded by the shareholders. There's a total of $6 billion, $6,118,000,000 worth of capital, and it's all equity, 100% equity. The cost of capital, which is not quite calculated on the screen, but there is another Bloomberg screen I could look at to find that. Their weighted average cost of capital is 100% equity times 15.6% cost of equity. There's no cost of debt, there's no preferred shares, so their weighted average cost of capital is just 100% times 15.6, or 15.6. Now if we take a look at the EVA calculation, this is where the news gets really bad. At this point in time, Blackberry had a net operating loss of $688 million. They actually recovered part of this loss from tax losses carried forward that they could use. So they're putting aside $444 million that they can reclaim later. So they say the net operating profit is minus 688 minus 444. So we have a net operating loss after tax and NOPAT of negative 244. To calculate the capital charge, they took the total capital employed in the business, which was $9,567,000,000, and they multiply that by the capital charge. And remember that our capital charge was the weighted average cost of capital, which was 15.6 that we saw in that earlier part of the slide. 15.6 was the weighted average cost of capital times 9,567,000,000. So that's where we got the 1490. $1,490,000,000 is our capital charge. We subtract the capital charge from the NOPAT. So minus 244 minus 1490 gives us an EVA of minus $1,734,000,000. Management has destroyed over $1 billion, $1.7 billion worth of value destroyed in this business in that particular year. Serious bad news. Now, the return on invested capital was the NOPAT divided by the invested capital of $9.567 billion. And that number is negative. So minus 244 divided by 9,567 gives us a return on invested capital of minus 2.55%. The EVA spread, as you recall, was ROIC minus R. So that would be minus 2.55 minus the R of 15.6, which is our cost of capital. And that's how we get the EVA spread. So the EVA spread is significant because this is the rate at which we're destroying shareholder value. You can see the pattern of the company over time. On this chart, we have over almost the last decade, we have got the value of the company in percent on the left-hand axis and in dollars on the right-hand axis. The yellow line represents our weighted average cost of capital. So it's always been high. It's always been about 15% or in that area. Today it's about 15.575%, or 15.6%. In good years, it looks like it dropped down to about 10% or even lower. But today, it's up to about 15.6%. The EVA, let's take a look at the EVA spread. EVA spread, this green line, again, in percent, shows that, well, today it's about minus 18%. Sorry, EVA spread. Yeah, minus 18%. And in good years, it's been up to about 25%. So a very positive EVA spread in the past, but today, definitely a very low number. The EVA in dollar terms is the blue line. And starting off with slight positive EVA, but take a look at the EVA that they created in the peak of Blackberry's success, around 2011, before they had problems with their operating system, before they had patent claims against their system. They were producing 40%, producing over on the right-hand axis about $2.5 billion per year in shareholder value. But with their problems that they had by 2013, that value had fallen off, and it's minus $1.7 billion, the total value of the shareholder value destruction that we see. This chart gives us a graphic view of what's happening in the company in terms of shareholder value creation and shareholder value destruction. We can take a look at a happier example in the next slide. This is Apple. Again, at this time, Apple was a company that was constructed principally of equity. So if we take a look at their capital structure and their cost of capital, they were made up of 100% equity, and their cost of equity was lower. The required rate of return to Apple was lower, probably because their business is much more stable, more profitable, and it's easier to attract investors. Their weighted average cost of capital then is 10.2. The calculation of EVA, this company has got net operating profit of $55 billion in this particular year. Their taxes were $9 billion, so $55 billion minus the taxes gives us $45.9 billion NOPAT. The capital charge is calculated by taking $140 billion of total invested capital and multiplying that by the weighted average cost of capital, 10.2%. That's where we get the capital charge of $14.2 billion. $45 billion of NOPAT, subtract a capital charge of $14 billion. That says we have EVA for this year of $13.674 billion. So a very substantial positive EVA. The return on invested capital is the NOPAT divided by the invested capital, and 45 divided by 140, we get an ROIC of about 32.7%. And if we take ROIC minus R to get the EVA spread, ROIC of 32.7 minus the discount rate of 10.2 gives us an EVA spread of 22.59. A very positive number, essentially tells us this company is creating massive amount of shareholder value. And from the chart, we see their cost of capital, the yellow line, fluctuates, but it's always around 10%. Nothing exciting, nothing too exciting about there. Their return on invested capital, the pink line, it has been a negative number in the past. And generally a positive number, and right now a fantastic number of 32.7%. The EVA spread, the ROIC minus EVA, and that's the green line. It has been a negative number at points in the past. It dropped down in 2004, but essentially a positive EVA spread, which means the company is capable of consistently producing shareholder value. And in dollar terms, the EVA has has been negative, but right now is positive, and the company is producing substantial amount of positive EVA. If you're looking at another company which has created reasonable amount of shareholder value and has a more complicated capital structure, here we have Shaw Communications, the Canadian-based family-controlled business that produces a lot of our telecommunication infrastructure and also entertainment, media, and so on. They're made up of equity, debt, and preferred shares. In fact, we looked at this example when we were looking at the weighted average cost of capital. So our weighted average cost of capital is 69.9 times a cost of equity of 7%, 28.6% weight of debt times 2.6%, their average cost of debt after tax, and the preferred shares. That gives us a weighted average cost of capital of 5%. And so that is our capital structure. Now, for the EVA part, the company has a net operating profit of essentially their EBIT was $1.377 billion. They paid $400 billion in taxes, so their NOPAT is $976 million. The invested capital and capital charge calculations, they have $12 billion in total capital invested in the business. Multiply that by 5.7, which is our weighted average cost of capital, gives us a capital charge of $697 million. Subtract that from the NOPAT, we still have a positive EVA of $278 million. And any number greater than 0 essentially means that's great. They're creating positive shareholder value. The return on invested capital, it was 8%, and we got that by taking NOPAT and dividing it by the invested capital. And their EVA spread, again a positive number, that's a great bit of news. The ROIC minus the 5.7% weighted average cost of capital gives us 2.29. And taking a look at the history, they've had some good years and some bad years, but essentially what we're seeing here is their weighted average cost of capital has gone quite high in some years, but essentially it's stable at around 5.7%. It has been for a little while. Their return on invested capital today is about 8%, but in some years it's been as high as, looks like about 12%, and in some years it's been low but never negative. So they've got a good and relatively stable rate of return on invested capital. The EVA spread today is 2.35, but we have some negative EVA spread going, especially in 2006, 2007, perhaps a little bit here in 2011, but generally positive. And the EVA in dollar terms, read off the right-hand chart, is $285 million, but as high as $400 million. And as low as a couple negatives in here as well, in dollar terms. So a history that provides us with some reasonable confidence. And in fact, as a company that is essentially a utility, we expect to see a positive and relatively small amount of positive EVA over time. Now, that takes us on to the next topic, and the most important one: how do you improve EVA? We've seen some examples of companies that have been successful in creating shareholder value, some that have destroyed shareholder value. So what's the trick? Essentially, we want to earn more profit without using more capital. It's kind of the idea that we're all familiar with it, the idea of working smart and not just working hard. Investing in more and more businesses, generating more and more revenue without generating profit is not smart. One of the things that successful companies often do to become more successful is downsize, doing more with less. And that was a big part of the TI story. Perhaps using less capital, investing less capital in the business, perhaps by selling off some of the divisions, returning some of the capital to the shareholders, especially if those businesses aren't profitable. Perhaps changing the capital structure and using more of the cheaper kind of capital, using more debt, and less of the expensive capital, using less equity. Perhaps we can refund some of the capital to the shareholders through stock repurchases or dividends. Most importantly, most fundamentally, moving forward, you should always be investing in projects that give us higher return. If our new projects give us a rate of return that's greater than our cost of capital, and we've measured our cost of capital correctly, then the EVA effect on the organization will always be positive. And we can go back through the organization and look at all of the profit centers within our business and say, okay, it's profitable, but does it give us a positive EVA? This actually ties together a lot of what we've discussed in the course already. I hope you're going to find it valuable as you look forward at businesses and companies that you analyze.